of Canada, surprise rate hike. Federal Reserve, we're hawkish. ECB raised. Bank of England raised rates. The only key countries that's cutting rates is China, because they're in a secular decline and they're going to be facing a recession from the rest of us. So the key thing is, let's look at the next meeting now, July 26th. We're at 70% that they're going to go 25, and that's the key point that I think the market doesn't get yet. Is this is the big cat and mouse game between the stock market and the Fed. And the Fed is not going to ease, in my view, ever, probably ever, until the stock market tells them to.
From hawkish pauses to rate hikes and dovish tones, the world's biggest central banks last week struck very different tones on monetary policy. Earlier this month, McGlone said that the second half of the year could be ugly for crypto assets and equities, as he believes the Federal Reserve is still on the path of increasing interest rates. McGlone says that risk assets, such as stocks and crypto, could get cheap in the coming months, as he believes that an economic recession is on the horizon. According to the macro strategist, the Federal Reserve is still on the path of increasing interest rates, which he notes could negatively impact the performance of Bitcoin and other crypto assets. According to McGlone, risk assets can get cheap in recessions. A cat-and-mouse game between the rallying stock market and watchful central banks could be an obstacle for risk assets. Cryptos are among the riskiest, and the inability of the Bloomberg Galaxy Crypto Index (BGCI) to sustain above its 2018 high in 2023 may be for a good reason. The Fed is still tightening. The BGCI tracks the performance of the largest crypto assets traded in USD. McGlone talks about rate hikes, commodity prices, and the stock market. He further points out that Bitcoin may not be as impressive as people thought, and he has his reasons for making such a statement. Let us now get into the video as Mike McGlone gives a macro outlook of the present economic situation. Don't forget to like, subscribe, and drop your comments below.
A bit of a worst case, kind of a delusional stage where the market hasn't figured out yet. So I like to point out a few facts. Went back and just figured out a little bit. You watch markets versus a 200-day moving average, and sometimes it gets too cheap, and sometimes it gets too expensive. So right now, the NASDAQ is 23% above its 200-day moving average. And that's since 2000, when it had that all-time high. It's only happened on 3 separate occasions. It almost always comes after it goes down a lot. Moving average tilts lower, and then it points back out again. The point is, it virtually never stays that high above a 200-day moving average. It's never happened with the curve this inverted. So that point to me is what the market doesn't get yet, is it's priced for all this normal human nature, optimism and hopium. They just forgot that the last almost 30 years, every time the market went down, the Fed was there to save you. This time it's going to be pointed out clear from all these Fed governors that we're not going to save you. We're focused on inflation. My forward-looking measures like PPI are collapsing, commodities are collapsing, but we're focused on our measures. And I don't see a win-win here for risk assets. Yes, I've been wrong, but now this is the way it always happens. You have to battle. You have to get that periods where people have, I think, irrational exuberance with a lack of fundamental understanding, meaning this is an economy that's just tilting towards recession. The Fed's going to make it go that way, and it's not going to save you until the stock market goes down. What did people get wrong a year ago, starting with crude oil? Initially wrong right away, and then it turned out that way. Why did the vast majority of people expect it to go stay above 100, and it's at 70, and still things like natural gas collapse? Because they missed the demand pull side of what's happening globally. Now, when's the last time we heard an upward revision of demand pull estimates from China? It's all trickling down. So that's a secular decline in this economy that just blasted off in the last 20 years. It is, we all know it's way overdue. Every single economy in the history of mankind, when it goes up that fast, has a significant correction. So that's just getting started. So let's look at its 2 main places what exports to. Now they're high now, but the thing I do on weekends is, some of us do, is I study and listen, read everything I possibly can. I hear a major divestment. Everybody's doing whatever they can to get out of China, and China's even doing what they can to get their manufacturing over to Mexico. So their main 2 clients, U.S. and Europe, not only did they obviously get them upset with this war, but they're going to a recession. What stops us? Well, they're all raising their rates. Why is China cutting their rates? So that to me is the beginnings of a global economic slowdown. Now, probably a recession. It's just getting started. The key thing is there's nothing here to save it at the moment. And then I look at things like Bloomberg Commodity Index. It's collapsed. You look at producer price index, they've collapsed. Copper's going down. All these things that really supposed to relate to that global economy. And then, so to me, the Fed, the fact is, they're still priced for tightening.
According to the market strategist, Bitcoin's rally above $30,000 this year could be seen as an overextended bounce within a macro bear winter. It's the enduring patterns of boons on the back of liquidity and busts when it's removed that tilts our direction bias for Bitcoin toward respecting the down-sloping 52-week mean. That the Fed has tightened twice despite its bank run may show the central bank's tenacity. Slumping copper and cryptos appear to be heeding the warning in contrast notably to the resilient stock market. Mike also commented on Bitcoin, stating that if Bitcoin was so great, how come it hasn't outperformed the Nasdaq? We would listen to his reasons in the video below.
Fact is, for commodities to bottom in this environment with the number one source, demand pull source for the last 20 years trying to hit kicking lower, is you basically need a long and variable lag to Federal Reserve easing. That means you need basically a weaker dollar. You need the Federal Reserve, that lower plateau. We're so far away from that, if history is a guide. So now I ask people, then if you expect commodities to go up, so what's going to cause that? Were you the people who were bullish last year? That's what's happened. We're in the early days of the supply and demand elasticity kicking in. We still have massive supply of all the production signs are still kicking up because they were a sell forward on the curve for same things like crude oil. And the demand is still ticking downward. It's just getting started. Like I said, the bottom line is right now, virtually every risk asset on the planet, most notably commodities, are completely subject to that stock market. It has to go up just for commodity to stabilize. And what's the risk? The stock market goes down and everything follows, like crypto. So that's the problem. Is it's all about the Fed and monetary supply right now, and they are still tightening. At least they're still expected to tighten. It's not just the Fed. The most coordinated central bank tightening in history is still going on. So when people talk about the end of the banking crisis, I'm like, what caused it? Well, rates are going higher. What really trick, and that's the key thing I'll end with. What really sparked part of this tilt towards still this fight for inflation is that the war in Ukraine spiked commodities, and they're just starting to come back. I'll just give the example. In 1980, the commodity index peaked, and then I think it took until 2003 to take out that high or something. I can look at it now, but it's usually how these things work. It takes a long time. If Bitcoin's so great, how come it can't outperform the Nasdaq? And I say that facetiously because it's a fact. The first time Bitcoin right now is at a ratio of about 1.76 to the Nasdaq. It was first traded that in 2017. Okay, so here are 6 years. If you bought Bitcoin in that day and you bought the Nasdaq in the same day, you have the same return. Yet you get much less volatility in the Nasdaq. You have this broad index. And by the way, typically you get support from the US government. You have the AI exposure. I'm bullish Bitcoin, particularly for what you said about all commodities, every single commodity on the planet, history commodities. People can create more with less every day. And the only really time they go up in the long term is when the currency they're based in is debases, i.e. the dollar. And I can show you how the price of crude oil now is the same price versus gold since 1931, I think. I can double check. It just fluctuates. But the key thing about Bitcoin, it has that definable diminishing supply, which I obviously point out a lot, but that's unheard of, never seen before in anything I've ever seen. Obviously, it has that low adoption and early days. Now, I completely believe in that in the big picture, but if I'm right, which I think I'm going to be about the stock market, and it needs to go down for the Fed to lighten up, then everything's going to go down. Cryptos will go down the most. They're supposed to. They're already kind of telling us there's a problem going down. Yes, there's other reasons. The Fed's cracking down. Why the Fed's cracking down? Well, because FTX went under. Why did FTX go under? Because cryptos went down. You see the connection there? But Bitcoin should outperform. It's just not there yet. And that's why I think we got to get through that period. We can see a decent bear market in the stock market. I mean, that's going to happen in our lifetimes. Maybe not this time, but it should happen probably by the end of this year. It should kick in, and to see Bitcoin outperform. And it's not right now. It's going down more. So I still look at it as I tilt back to U.S. government Treasury notes until I see that divergence.
The European Central Bank on Thursday hiked rates and surprised markets with a worsening inflation outlook, which led investors to price in even more rate increases in the Eurozone. This followed a Federal Reserve meeting where the central bank decided to pause rate hikes. Just days before that, China's central bank lowered its key medium-term lending rates to stimulate the economy. In Japan, where inflation is above target, the central bank has left its ultra-loose policy unchanged. Taking all these different approaches together shows that not only seems there to be a new divergence on the right approach for monetary policy, but it also illustrates that the global economy is no longer synchronized, but rather a collection of very different cycles. Carsten Brzezinski, global head of macro in Germany, told CNBC via email. In Europe, inflation has come down in the bloc, which uses the euro but remains well above the ECB target. This is also the case in the UK, where the Bank of England is expected to raise rates Thursday after very strong labor data. The Fed, which started its hiking cycle before the ECB, decided to take a break in June, but said there would be another 2 rate increases later this year, meaning its hiking cycle is not yet complete. The picture is different in Asia, however. China's economic recovery is stalling, with falls in both domestic and external demand leading policymakers to step up support measures to revive activity. In Japan, which has battled a deflationary environment for many years, the central bank said it expects inflation to come down later this year and opted not to normalize policy yet. Each central bank tries to solve for its economy, which includes considerations for changes in financial conditions imposed from abroad, Eric Nielsen, Group Chief Economics Advisor at UniCredit, said via email. The economic woes around the world tend to have intensified as so many world economies are grappling blindly with anything they can get to help stabilize their economy. What implication does this have on your economy? Let us know in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.